Is Social Security taxed? Yes. No. Sometimes. I'm going to teach you in 9 minutes how to answer that question for yourself. And if you're years away from filing for Social Security, I'll tell you what you can be doing ahead of time that could allow you to pay less tax on Social Security and whether or not it's worth worrying about. Hi, everyone. I'm Scott Reinhardt, a CPA and financial planner, and I have 9 minutes to teach you how Social Security is taxed. I've met with over 1,000 families close to retirement the last 6 years, and guess how many thought that Social Security should be taxed? But that's not what this video is about. I'm going to focus on how it's taxed because I want you to understand how decisions you make well before you file for Social Security can affect how much it's taxed when you do file. Let's learn. So here's why taxes on your Social Security gets a little complicated. It depends on how much other combined income you have, and they call it provisional income, and it's another income that we have to keep track of. You know, we already have adjusted gross income, taxable income, modified adjusted gross income for calculated premium tax credits, but I'm not getting in any of those in this video. So to get to provisional income, we have to add up all of your non-Social Security income, like IRA distributions, pensions, dividends, capital gains, even add back tax-exempt interest. And then the goofy part is that instead of taking your full Social Security, they take 50% of your Social Security benefit. So let's look at an example using this fantastic spreadsheet from Dan at 55E. 55 Elephants. I'm not sure what the story is behind that, but I love it. And he has amazing spreadsheets that you can use for retirement planning, tax planning, financial planning in general. So shout out to Dan for this awesome spreadsheet. And looking at this example, let's assume that you're single and you have $22,000 in pension income. You have $30,000 in Social Security. You have $10,000 in qualified dividends and long-term capital gains. Now let's also assume that you're going to have a $12,000 IRA distribution. So to determine provisional income, we take half of the $30,000 to get us $15,000 of Social Security that's used for the calculation. Then we add up your pension and capital gains and dividends. That's 22 plus 10 gets us to 32. Plus we had the 12,000 in IRA distribution, which when we add all that up gets us 59,000 in provisional income. Now we go to the threshold tables. Now when you're single, the threshold is any provisional income from 0 to 25,000 is at 0%. So that's easy math. From 25 to 34,000, that's at 50%. So 34,000 minus 25,000 is 9. Times 50% gets us to 4,500. Now, 59,000 minus 34,000 is 25,000. At 85% gets us to $21,250. When we add those two up, 4,500 plus 21,250, we get to 25,750. But the max that they tax Social Security is 85% of it. So 85% of 30,000 is only 25,500. So 25,500 is how much of that 30 is going to be taxed. Okay, so what happens if we use the same income numbers, but we change this from single to married filing jointly? It's all the same. So provisional income, still 59,000. The difference is that our thresholds are slightly different. So now from 0 to 32,000 is at 0. 32 to 44,000 is at 50%. And 59,000 minus 44,000 is 15,000 times 85% gets us 12,750. When we add those up, it is $18,750, which is only 62.5% of this couple's Social Security being taxed. Now here's a sneaky little trick that the government plays on us, and it's that these thresholds don't go up with inflation. You know, tax brackets go up with inflation. The standard deduction tends to go up with inflation. Social Security benefits go up with inflation, but these thresholds don't. So in effect, every year, a higher percentage of your Social Security is at risk of being taxed. And when they first started taxing Social Security during the Reagan administration, only 10% of people receiving benefits were taxed on it. Now it's well over 50% of Social Security recipients pay some tax on their Social Security. All right, enough of that though. Back to some examples. So we're back to our married filing jointly couple, but now I want to test what happens when we add a $5,000 additional distribution from an IRA. So this tax deferred withdrawal, let's up that to $17,000 instead of $12,000. What's that going to do? It's going to up provisional income from $59,000 to $64,000. So we do all that same math, but now this number has gotten a little bit higher. And now instead of $18,750, it's $23,000. And now instead of 62.5% of Social Security being taxed, 76%. So what effectively just happened is this couple, they took an additional $5,000 out of their IRA. So that's $5,000 of taxable income. Plus they added $4,250 of their Social Security that was additionally taxed. So that $5,000 IRA distribution caused $9,250 in additional taxable income. This is why taxes in retirement are not as straightforward as they are while you're working as an employee. And it's also why you'll hear about folks who don't pay any tax on their Social Security and maybe don't even file a tax return. I've actually heard a few times, well, my 85-year-old mother hasn't filed a tax return in years, so I just assumed you didn't have to pay taxes on Social Security. Well, watch what happens when we remove this other income. So say this person doesn't have a pension, and what if they don't have any qualified dividends or capital gains? They just have Social Security. Well, actually, I'll just keep the $17,000 IRA distribution. Provisional income's only $32,000. Guess what? 0 to $32,000 in provisional income is at 0%. They don't have anything from 32 to 44, so it's just zero. None of their Social Security is taxed. And very likely with standard deduction and things like that, they owe no tax. So if you're in your 50s or even early 60s, what could you be doing now to lower the future taxes you'll pay on Social Security? Well, you could be proactively prepaying taxes, hopefully at a discount, on your IRAs through strategic Roth conversions. You could be strategically taking capital gains and making sure your taxable brokerage accounts are built for tax efficiency. Or you could go to the extreme of lowering your expenses now so that you can withdraw less, sell less investments, and lower your income once you've started Social Security. But let me ask you, is it worth it? At a certain level of net worth and income, it just doesn't make sense to lower your lifestyle just so you don't pay tax on Social Security. That's one of the most unfortunate things that I see in very smart people who've retired and they just become obsessed with paying less tax. And listen, my entire business is built around helping people pay less tax in retirement, but paying less tax isn't the end goal. The end goal is to use the money you save on taxes to spend or give how you want to. So if you're living a smaller life than necessary just to save on taxes, you might be missing the point. So keep that in mind. Paying tax on Social Security is not the end of the world, but that doesn't mean we shouldn't try to be as efficient as we can. If you want to learn a lot about Social Security, I recommend you check out Devin Carroll's channel. He's another financial planner, and he just knows Social Security inside and out. Now, did you learn something in this video? If the answer is yes, then I only ask that you hit the like button and consider subscribing. Until next time.